Welcome to the channel. Today we unpack a high-stakes decision many homeowners with jumbo adjustable rate mortgages face. Should you aggressively pay down a sub 4% mortgage or invest the extra cash in the market? We'll explore principles, scenarios, and a decision framework so you can act confidently. First, let's preview what's ahead. Here's our roadmap. We'll define the dilemma and the math behind comparing a low-rate mortgage to potential market returns. Next, we'll examine principal reduction as a rate shock insurance strategy, followed by a liquidity and leverage approach focused on optionality and investing. Then, we'll compare them side by side, plan a timeline leading up to the ARM reset, and finish with an actionable decision framework. We'll also include a couple of quick quizzes to reinforce learning. Now, before we dive in, a quick but important disclaimer. Disclaimer: this content is for educational purposes only and does not constitute financial, tax, or legal advice. Your situation is unique. Mortgage terms, tax treatment, risk tolerance, and investment options vary. Please consult your own advisors before making decisions. With that said, let's frame the core dilemma. The central trade-off starts with your current low rate, around 3.875%. which is objectively cheap debt compared to historical equity returns of 7 to 10%. If you prepay this debt, you secure a guaranteed after-tax return, roughly equal to your mortgage rate. If instead you invest, you pursue higher expected returns but accept market volatility. However, because this is an adjustable rate mortgage, the reset in the future adds a second layer of risk. Your payment could rise significantly if rates stay elevated. Therefore, your decision is not only about return versus cost, it's also about risk management and future cash flow stability. Next, let's quantify the core principle that guides many financial independence perspectives. At the core is opportunity cost. With a debt cost of about 3.875%, investing in broad equities with long-run returns near 7 to 10% can create a positive spread. The difference compounds, which is why many recommend prioritizing investments, especially within tax-advantaged accounts like a 401k, IRA, or HSA. Yet the ARM reset introduces potential future payment shock. If rates remain above 6%, your payment could rise materially. Thus, we must weigh return potential against risk of cash flow disruption. To address that risk directly, consider the principal reduction strategy. The principal reduction approach focuses on certainty. By making large lump sum payments each year, say $50,000, you aggressively shrink the outstanding principal before the reset happens. When the ARM adjusts, the new payment is calculated using the prevailing rate and the then current balance. A smaller balance means a smaller payment regardless of rate direction, thus muting the impact of higher future rates. This approach suits those who prioritize stability, predictable cash flows, and sleeping well at night. Now, for the other side of the spectrum, let's consider liquidity and leverage. The liquidity and leverage approach goes on offense. You invest your surplus now, aiming to outpace the mortgage rate and build a larger asset base. As you near the reset, you maintain a meaningful liquid reserve in high-yield savings or CDs to keep optionality. If rates fall before the reset, you refinance to a lower fixed rate. If rates rise, you use the accumulated capital to make a large principal paydown right before the reset, or to buffer higher payments. This strategy is for those comfortable with market volatility and timing flexibility. Next, let's compare these two playbooks side by side. Comparing the strategies. Principal reduction is like buying insurance. It reduces uncertainty by ensuring a lower balance at reset, directly tackling payment shock. However, your return is functionally capped near the mortgage rate, and tying cash to the mortgage can lower flexibility. Liquidity and leverage, by contrast, maximizes optionality. You maintain the ability to deploy cash when it matters, either refinancing if rates drop or making a large paydown if rates rise. The trade-off is market risk and the need for behavioral discipline. If markets underperform, or if you fail to preserve liquidity, payment shock can be amplified. Now let's look at illustrative scenarios to ground expectations. This table is illustrative, not precise. It shows general directional outcomes over 6 years. With annual principal reduction, the ending balance is lower than the baseline, which mutes payment shock at a 6.5% reset rate. If you invest and keep cash without paying down the mortgage, the ending balance is higher, so your payment at reset is higher compared to the principal reduction path, but you retain a substantial liquid cushion. A hybrid approach splits the difference, offering moderate payment risk alongside some liquidity. These are simplified directional comparisons. Your actual figures will depend on amortization schedules, term remaining, margin, caps, and investment returns. Next, let's map the journey to the reset date. This timeline highlights key milestones between now and the reset. In years 1 through 3, you either commit to annual prepayments or invest aggressively while prioritizing tax-advantaged contributions. Conduct yearly rate check-ins to track trends and refinancing feasibility. In years 4 through 6, emphasize liquidity buildup so you're ready to act. If rates fall sufficiently, consider refinancing earlier. 1 to 3 months before the reset, decide whether to deploy a lump sum principal payment to reduce payment shock, or keep liquidity to cover higher payments. Finally, align your post-reset budget with the projected payment. Now let's convert this into a practical decision framework you can follow. Here's a practical framework. First, maximize tax-advantaged accounts because their benefits often dominate. Second, pick a philosophical stance. Do you value insurance and certainty more, or optionality and potential returns? Third, run your specific numbers, including index, margin, caps, remaining term, and amortization type. Fourth, stress test your plan by modeling higher reset rates, market drawdowns, or income changes. Fifth, set a glide path, either a principal reduction plan, an investing plan, or a hybrid. Sixth, automate contributions in calendar, an annual review of rates and refinance opportunities. Finally, about 6 to 12 months before the reset, reassess. Refinance if it's compelling, deploy a lump sum to principal if needed, or retain cash to manage payments. Before we summarize, let's test your understanding with a quick quiz. Quiz time. Question: when an RM resets, how does prior principal reduction affect your new payment? Option A: it has no effect, only the interest rate matters. Option B: it lowers the payment because the balance is smaller. Option C: it raises the payment because you paid less interest before. Option D: it only helps if rates drop below your current rate. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is, it lowers the payment because the balance is smaller. When the loan resets, the new interest rate applies to the remaining principal. Lower principal directly translates to a lower payment, all else equal. Now let's try one more question focused on liquidity and flexibility. Second quiz. Question: what is the primary advantage of keeping funds liquid until just before an ARM reset? Option A: you avoid all market risk. Option B: you guarantee a lower rate at reset. Option C: you preserve optionality to refinance or make a lump sum paydown. Option D: you eliminate closing costs entirely. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is, you preserve optionality to refinance or make a lump sum paydown. Liquidity lets you adapt to changing rate environments, either locking in a refinance if rates fall, or reducing balance to soften payments if rates rise. Now let's cover key risks and considerations before we wrap up with a markdown deep dive and visuals. Key risks include behavioral pitfalls, like failing to preserve invested cash, or panic selling during downturns. Refinancing may not be available at favorable terms if rates stay elevated, or if credit standards tighten. Tax treatment of mortgage interest can be nuanced, with deductibility limits depending on timing and amounts. Consult a qualified tax professional. Liquidity risks arise if you over-allocate to prepayments and then face income disruptions. Finally, market risk and the sequence of returns matter. Negative returns early can undermine the liquidity strategy's effectiveness. Next, let's present a markdown deep dive to crystallize the main equations and choices. This is a placeholder